Hello and welcome. Today we're going to examine a specific financial instrument, the Charitable Remainder Unitrust. We'll walk through what it is, how it functions, and the ways it can be used in both financial and philanthropic planning.
So here's our roadmap. We'll begin by identifying a common financial challenge. Then we'll introduce this trust as a potential solution, cover its mechanics and advantages, and finally discuss its role in fulfilling charitable objectives.
All right, let's start with a very common scenario. Imagine for a moment that you're holding a highly appreciated asset, perhaps a large holding of company stock that has grown substantially in value over the years. This leads us to the core problem. How do you diversify out of that single concentrated position to reduce your risk without facing a major tax bill? That potential tax event is often the single biggest hurdle to making a change. Well, the conventional path is simply to sell the assets, but that action, of course, immediately triggers capital gains taxes. And the result? You're left with a smaller principal to reinvest, which shrinks the very capital base you're trying to grow and diversify. So, with that dilemma in mind, let's turn to a potential solution. The Charitable Remainder Unitrust, or CUT, and it's pronounced CRUT. At its heart, a CRUT is an irrevocable trust designed to accomplish two primary things. First, it provides an income stream to a beneficiary, often the donor and their spouse, for a specified period of time. And second, when that term ends, the remaining assets pass to a charity that you have designated. Okay, so how does this structure work in practice? Let's take a look at the actual mechanics. The process begins when you transfer your appreciated assets into the trust. Now, here is the key step. Because the CRUT is a tax-exempt entity, it can then sell those assets without triggering an immediate tax liability. This allows the full pre-tax amount to be reinvested into a diversified portfolio. From that point on, you receive annual payouts, and at the end of the trust's term, the charity receives the remainder. Now, what about those annual payouts? How are they calculated? A CRIT is structured to pay out a fixed percentage of the trust's value each year. A common figure for this payout is 5%, though this can vary depending on the structure. This is a crucial detail. That fixed percentage is applied to the trust's fair market value, which is recalculated every year. This means your income stream can fluctuate. If the trust's investments perform well, your payout increases. If they perform poorly, it decreases. This structure also provides the flexibility for additional contributions to be made to the trust over time. As you can imagine, this structure presents several key financial advantages, most of which are centered around tax efficiency. The primary advantage is the deferral of capital gains tax. By contributing the asset to the CRUT before the sale, you avoid the immediate tax event. This allows the trust to invest the full pre-tax value, giving your new diversified portfolio a higher initial base from which to grow. This can, of course, be a benefit to both you and the eventual charitable beneficiary. Beyond tax deferral, there are other important benefits. In the year you fund the trust, you may receive an immediate charitable income tax deduction. This deduction is based on the calculated present value of the remainder interest, that is, what the charity is projected to receive. Importantly, this value includes the asset's untaxed appreciation. If the deduction is larger than you can use in a single year, it may be carried forward for up to 5 additional years. Finally, a CRUT may also generate an estate tax deduction if it is established through a will. Now, beyond the financial mechanics, it's essential to remember the core purpose of a CRUT. Fundamentally, it is an instrument of philanthropy. The trust is built to achieve two goals simultaneously. It provides an income stream for you during a set term, while also ensuring that a significant gift is ultimately directed to a charitable organization you wish to support. So you can think of it as a way to integrate your personal financial strategy directly with your long-term philanthropic objectives. The two are aligned within a single structure. The final question, then, is whether this type of trust structure could be a component of your financial and legacy plan. A CRIT is a sophisticated instrument, and it is essential to explore it with qualified legal and financial advisors to determine if it is a suitable strategy for your specific circumstances. Thank you.